Hello, everybody, and welcome to the next episode or this episode, I should say, of the Cross Country Super podcast. And we're excited to let you know that this episode is proudly brought to you by Zagger, generating fixed income style returns with an investor first approach. Why zig when you can Zagger? And of course, I'm joined today, as usual, by the lovely Jemma Sanderson over in Perth. I see you've got lovely weather over there. I did have a look at the forecast. You're still in the high 20s, which I'm very envious of. So welcome, Jemma. And as usual, it's great to have you on.
Thanks very much for having me, Darin. It is. It's unseasonally warm over here, and we're all waiting for the reality check of it
No,
starting to
no,
be. And
don't
for us,
jinx it.
cold is not really that cold. But anyway,
No, don't jinx it. I'm envious. Anyway, today we're going to discuss year-end strategies, and of course, we're squeezing this all in before the 30th of June just to alert listeners to what are the sort of things that should be on their radar as far as getting their SMSF in order before the year end comes about. And so I think we'll kick it off by probably the most obvious topic to discuss, and that is contribution strategies. And of course, they take a bit of an extra significance this year because there is indexation on its way for the concessional contributions caps, and that can give you a bit of a bonus in this financial year, as well as obviously the subsequent financial years when it will be at the higher level. So, Jemma, let's get into it. Obviously, I'm actually referring to contribution reserving.
hmm
As far as concessional contributions go, I probably shouldn't use that term. It's more of a suspense account,
yeah,
and
that's
the
right.
ATO's even said that we don't consider that SMSFs have reserves anymore, but this is commonly known as contribution reserving. So, I'll hand it over to you to explain how it all works.
Right, and I agree. Like I feel like we've been calling it contributions reserving for so long that it's going to be really hard to call it a contribution suspense account or contribution in suspense. I don't know. Contributions reserving is the easiest way to describe it. And yeah, so there is that bit of a kick available if people want to use next year's extra cap for this year. And the other thing that sort of can also dovetail into that is the carry forward concessional or unused concessional contributions. So in the circumstance, so this is the first year, 23-24, where you've got the previous 5 years available. So since 1 July 2018, they're all, may have accumulated. So we've got, I'll call it the full whack available, which is 130,000 if you haven't done anything since 1 July 2018. And then when you add this year's 27 and a half, if you haven't done anything, it's 157,500 that you could contribute to super and claim a tax deduction for. So there certainly could be some opportunities there. You do need to have your total super balance less than 500,000 at 30 June 2023. So that's something to be available. But back to your contributions reserving. So that would enable, if you wanted to use it, again, self-managed super funds are where we're talking, and contribution that you make in June, you could reserve it or put it into suspense so that it doesn't count towards the contributions cap until for next year. So you can claim a deduction for it this year, and then it counts towards your cap next year. Now, it only applies in situations where you make the contribution in June, because you're looking at the provisions, SIS regulation 7.082,
Yeah.
and it talks about you've got 28 days after the end of the month of the contribution to allocate it to the member's account. So that's why a contribution in June can be reserved or put into suspense until July. The other consideration with that is it's got to be a separate contribution. So you can't put into suspense part of a contribution. It's all or nothing. So if you want to use the provision, you've really got to make either, if you want to use your 27 and a half this year and then use your 30 for next year, they've got to be two distinct and separate contributions that are made from that perspective. But definitely an opportunity there. The other consideration with that is making sure that you complete the form for the ATO when the SMSF annual return is lodged, so they know it's a suspense contribution and can treat it as that.
Yeah.
The downside of using the reserve is that that's using up next year's cap early on in the year. So if you've got someone who might be employed, their super guarantee will then put them into excess potentially next year, depending if they've got carry forward that might apply next year. And then next year you can't claim a deduction unless you then do it again in June next year. So you're really just getting the one-off double up. And then subsequent years, you're looking at making contributions in June for that year. But if you've got a bit of a windfall this year where it's worthwhile, the other thing is to watch out for obviously Div 293 tax as well from that perspective.
Yeah, and of course the great thing is you get that double tax deduction in the current financial year as opposed
That's right.
And of course the suspense bit will actually be a bigger deduction than you would be used to because of that indexation factor.
Yep, that's right.
Now, one of the things, Jemma, and this isn't all just about strategy, there's a lot of sort of housekeeping associated issues with that. I mean, contributions are not just a matter of, oh yeah, I'll do it and it'll be fine. You got to get the timing right around this, don't you?
Totally.
Especially at this end of the year because it's definitive, right? So end of the year is definitive. Now, there's a bit of a catch this year because I believe the 30th of June falls on a Sunday.
Yeah, Sunday.
So what do people need to consider there as far as having the contribution recognized so you're not in a position about, oh, but I meant for that to go in last year. How come it's not showing up?
Well, and that's a real concern, especially when the 30th of June is on a Sunday, because even though a lot of bank transactions and transfers can happen immediately, sometimes it still doesn't show up in the destination bank account until a day later or subsequently. So you really want to give yourself enough leeway because under the tax ruling, excuse me, the contributions ruling, and I'm going to get this wrong, TR 2010-1, I think it is, the comment there is that the contribution is considered to be received by the fund, and that's the year that it's made. So that receipt is cash. It's got to be in the fund's bank account by 30 June. And so what we would suggest is that people are making sure that Monday of that last week, so that would be, I've got to get my dates right, the 23rd, the 24th of June. That's almost like the last date, just to be sure. And I know a lot of the big funds, they have their cutoff like mid June for contributions, saying, look, it's got to be by the 15th or whatever, if not earlier. So it's worthwhile being on top of those things. The last thing you want is it's Friday, the 28th, and you're trying to make sure that these contributions come through. Now, if you can't do the cash at that time, then there's a few sort of workarounds. One is you rock up to the bank and hand, a check across the counter. So that can work. You can hand the cash over at the counter. So you're going into the bank from that perspective. The other one is, so that's the cash side of things. The other important one is if people are looking to do off-market share transfers. So they need to make sure that the off-market transfer form is in what's called registrable form. So if it's been signed off by everyone and it could go to the share registry, and the share registry can change the legal ownership of that. So it's a change of beneficial ownership, not just the legal ownership. And that also applies to property transactions. But mostly when we're talking property and shares, it's generally in the non-concessional cap or non-concessional contribution strategy space, which I'm sure we'll get to. But yeah, the biggest ones is that cash element, making sure it's done on time, because I've always find it quite strange when 30 June is on a weekend. Just doesn't feel right.
Yeah, no, and I did not. So the ATO actually did issue a reminder recently about this sort of stuff and what you need to get together before that happens, and obviously there have been alerts about 30th of June falling on a weekend and how significant that will be. Now, one of the things I saw was that they did make some sort of allowance to say that if you use the same bank for your personal banking and for your SMSF, potentially that transaction can be processed on the same day and potentially it could go through on the weekend.
Yep.
So they did, I think they
There's
had
a
to.
lot of potentialities there, and
Yeah,
it
I
depends
think
and
basically they had to acknowledge that,
uncertainty.
right? Yeah, just so that somebody doesn't stick up their hand and say, "Oh, hang on a minute, my bank allows me to do this." But I think it always comes with the warning of don't rely on that. And I don't know anybody in their right mind who actually would rely on that because you are literally leaving it to. It's not even 1 minute to midnight. It's what 10
No,
seconds to midnight to try and um, exact a strategy like that. So I think they had to acknowledge it just in case, as I said, some people say, oh, hang on a minute, you don't have that right. But I don't think anybody in their right mind would be relying on that if you desperately needed to get that contribution in before
well,
the 30th of
exactly.
June. And
Yeah,
I'm
that's
sure no
so.
one would advise them to do that either.
No, well, I have had situations previously where the person, their birthday, their 60th birthday was on the 30th of June, and that's when
Oh
we wanted
no.
their pension payment to be made. And because then it was tax free. And so it was, oh, how do we make sure that that pension payment gets made? So again, using a check, but checks don't exist almost anymore. I personally have never owned a personal checkbook, so
Really?
I'm not that surprised that they're being phased out from that perspective. But anyway,
I do just
and
an
you're
aside.
just saying, really, Gemma, is that you
Well,
implying that I'm old, are you, Darin? Which I would
well,
acknowledge.
just an aside. I actually still do use checks, not often, but I've always still got a checkbook. And people often ask me, "Well, why do you do that? Like everything's done electronically now. Why do you need that?" And I often tell them, look, when all of the systems go down, you can always
Yep.
write a cash check and bank it, which means you get cash in your hand. You don't have to worry that the whole ATM network is finished and
Yep.
the internet's down. You can walk into a branch and actually withdraw cash with a cash check. So
Well, like when
I always use that as
it
a
used
safety net.
and like when Optus went down for that
Yeah.
24 hours, like so many businesses couldn't
Yeah.
couldn't operate because they didn't have, like, they were like, we're cashless now,
Mm,
so people couldn't buy, or they probably, no one carries cash anymore, let alone a check. And
yeah.
actually, to digress, which we're very good at, I think there's a Roadhouse in regional WA where they've gone, we're not cashless, we are cash only. And so I thought that was
Oh,
quite interesting.
good
Yeah,
on
and
there.
they've had really good feedback on that from that perspective. So yeah, anyway,
Yeah, good
interesting.
on there. I actually can admit that it's a bit of a strange experience pulling cash out to pay for stuff.
Mm,
I've consciously made an effort to do that recently, and it's a bit weird because you're so used to tapping your card. It's like,
yeah.
oh, I've got to give you this and get some change back. It's strange how quickly we get used to doing stuff. But
Oh,
anyway,
totally.
we've completely gone off piste again.
We have. We're good at that though. We're good at
We'll
that.
ski back to the black run
Yep.
as
Yes.
it would be. And you did mention before about non-concessional contributions. So let's have a bit of a chat about that and what considerations need to be made as far as those contributions go.
So helpfully that's going to be indexed as well next year. So it's currently 110 per annum or 330 or up to 330 with bring forward. So you could have a 220 bring forward or a zero bring forward if you're over your 1.9 million. And that's going up to 120,000 for the single. Now, the consideration at this time of the year is usually if we were chatting to clients about, oh, yeah, non concessional contributions, and on the basis they've got the money to contribute whatever they want, we would be saying, look, it's May, June. There's no point in doing 330 now when you could do 110 now and 360 next year. So within the space of a few weeks, you can get $470,000 into super, and then that's invested, long term, blah blah blah. And if it's between a couple, there's north of $900,000. And then if you couple that with some concessional contributions, there's a real opportunity to get more than $1 million into super for a mum and dad over a really, really short period of time. So that sounds like a great strategy, again, on the basis that they've got the available resources to do so. So that's pretty good. So from that perspective, you'd be looking at, do you just go down that path, 110 now, wait, and then do 360? But we've always got to overlay with non-concessional contributions the total super balance thresholds. So firstly, to do the 110, so you've got to have under 1.9 million. Now, if you just had under 1.9, you'd only have the 110 available. To do the bring forward next year, you need to have under 1.66 million. This year, you only needed to have under 1.68 million at 30 June 2023. So it's gone backwards because the contribution caps have gone upwards because the transfer balance cap was not indexed. So it's not confusing at all, is it? So the challenge that we encounter at this time of the year is, okay, Darin, yep, usually we would say 110, then 360. And let's say at 30 June 2023, your total super balance was under 1.68. Great. It sounds like we can make that happen. But then we have to factor in, well, if we added 110 to your account now, is that going to push you up over those thresholds? And that balance at 30 June 2024 is then going to determine whether you can do the 360 or not. So let's say you are under 1.68 at 30 June 23. So you're thinking, yep, that's great. Maybe it was 1.2 million. And you're thinking, oh, I'm well under, no issue at all whatsoever. But you're invested in something that has performed really, really well. So actually, before you've made any contributions, right now, you're over 1.9. Or you're within those thresholds. So you're not going to be under 1.66. So the consideration there is, right, well, we could wait and see what happens. And you can, in light of what we've just discussed about timing, you might not want to wait till the 30th of June or even a week earlier. Maybe it's mid-June. See what the position is of your fund in terms of its investments. Are you going to be over? And if that's the case, maybe you actually use the current year's bring forward and do 330, because once you get to 30 June 24, you're not going to have that opportunity next year to make those contributions. So that's sort of managing, like, what's the current balance all the way up to, the end of the financial year to see how that sits. So that's one of the considerations there. So it might be, oh, well, I could do 3 years now, but I want to put in an extra, it would be an extra sort of 140 grand. But it could be that you can't put in anything next year from that perspective. So just to watch out for that. And I did have something very insightful to say in addition to that, but it just escapes me now. So that's one of the main things to have a look at with respect to that strategy. Then you've got the approaching age 75. So at least you can make those contributions all the way up to age 75. The other thing you need to look at is the contribution history. So if you had made contributions a couple of years ago already and you're still serving a bring forward, then you may not be eligible to do it this year. You have to wait to next year. So again, watch out for that contribution history. The other thing is, if someone is going to go over and it looks like they might have more than the upper threshold or even that 1.66, if they're eligible to, one of the options that you do have is to put in place a withdrawal and recontribution strategy. So you could pull out a lump sum from the fund before 30 June, which then impacts the total super balance, pulls it down, and then in the new financial year, they make the contribution. Now, if they're already at that level, why would you bother if you're just sort of recycling some money around? And that could be part of a wider estate planning strategy, looking at the tax components. The other situation where we see that working is where you've got, mum and dad funds, and one of the members has got a substantially higher balance. So you pull down not only their own available non-concessional cap if they were lower than the cap, but than the thresholds, but the one for their spouse. So then that gets them well and truly down, and they can both make a non-concessional contribution, and that's helpful from managing the taxation components from an estate planning perspective, plus then multiple transfer balance caps available, managing like well into if we're at that level, we're still quite a lot below the $3 million threshold. So, it's also managing that the future and the expectations there. So it's watching out. And it can be a challenge. So, practically, how do I know what Darin's account is worth on the 1st of June, if that's when you're looking at it? Well, you can sort of do a market valuation of the assets, but if you've received a bit of income in there's going to be some franking credits coming back. There could be a real change between over that month from a valuations perspective. So, and if you're in a fund with 3 other members, then you're having to do sort of a best estimate potentially. Most of the modern software you can get pretty close, but also you're never going to get that exact amount. So if you're in the situation where you're really close to thresholds, then that would be when you probably need to take a little bit of extra time and make sure that the contribution history is looked at. The other thing that we encounter with that is watch out for people making after-tax contributions to the insurance-only super funds. So their insurance premiums are coming out of their personal bank account, but it's a superannuation an insurance only super account. And so they're classified as contributions. So you don't want that to accidentally trigger, say if you put in 110 this year to make 360, but you've also got $5,000 worth of those insurance payments coming, or these insurance premiums, then you've triggered a bring forward in the current year. So it's really being super conscious of what that looks like.
Yeah, I love it. Whenever we talk contributions, there are so many thresholds to be considered. I mean, just in that very brief conversation we just had, we mentioned the $500,000 total super balance for any carry forward concessional contributions. We've also got those bands with the carry forward non-concessional contributions, as well as the total super balance figure where you can't make any contributions anymore.
Yeah.
So many thresholds and so many things to consider before you would think an easy exercise of putting money into your super account would make perfect sense, and it would be perfectly easy to do. Now, on the topic of thresholds, determining thresholds is obviously a very important point, as you just said, Jemma. Obviously, figuring out what your total super balance is. And that brings us to another point where, or another issue that's particularly relevant at this point in time. And that is the valuation of assets.
Definitely.
Making sure that we've got the right asset values, because you don't want to be caught out by this sort of stuff, because it will lead to obviously unwanted compliance issues down the road if you do get this wrong. So, what considerations do people need to take there? And again, I think in a previous podcast, we've said that the ATO is pretty red hot on this right now.
Yep, definitely. And so are the auditors. So they're pushing back where they can't see the actual evidence to support a value. Most of the time, and by and large, we're probably talking here direct property. So is this the chance for you to, is it time for a proper appraisal or an independent valuation to be done? A lot of trustees are put off by the cost of that, but it's, and there's a lot of misnomers there about, well, if you've got a valuation, you can use it for 3 years. So that's actually not correct. Every year, the market valuation of the assets is required to be determined. Now, if you've got a market valuation done by an independent valuer and things haven't changed, then perhaps you can use that value for the purposes of a few years, but then it always needs to be sort of revisited to make sure that you're ticking the boxes there. And the other thing with that is, so that's like a capital valuation, then there, especially if it's being leased to a related party, we're talking commercial property mostly here, there wouldn't be that many residentials unless it was under the in-house assets test. Could be some of them. Anyway, you're looking at making sure that the market rent is being paid there as well, and that also is in line with the lease agreement. So again, making sure that you're looking at that lease agreement. The other thing with the market valuations is we're not that far off. 1 July 25 is when Div 296 tax is coming in. Well, at the moment they're debating in Parliament whether to pass all of that. So we know the Senate committee has sort of pushed it back with no changes at this stage at the date of recording, and so we're looking at 1 July 25. Is it worth evaluation to be done now to see where things land? But again, the requirement of that is every year it needs to be valued. So there's been a lot of movement in property values. So now might be the time to also go down that path and have that looked at. And especially if you are knocking up against these thresholds and you want to be making those contributions, getting a valuation done now rather than waiting until after 30 June to have an effective 30 June one, that could be worthwhile from that perspective as well.
Yeah, I think it's prudent to point out that if you think this is a sleeper issue for the ATO, it's not.
Yeah.
They have actively said that, particularly with property valuations, that they would definitely be looking at whether or not your property valuation has changed year on year because of the fluctuations in the property market, especially if you've got an investment property in Sydney or Melbourne, because they know that those values have definitely changed over that period of time. And if your valuation hasn't changed over that period of time, that will be a red flag to the ATO. They have already said that. So it's not something that you can probably argue away. The application of common sense with market movements is definitely the basis of what they look at as far as that goes. So just
And it's
be
quite interesting the number of files that we pick up, new clients or we're doing some consulting or whatever on a fund, and it's been the same value of the property for 5-6 odd years. So then I guess the consideration with that is that my expectation is that the auditor would have picked that up and perhaps said, look, Jemma, you've got the same value of this property here, and perhaps qualified the audit report. But if there could be more questions asked because it is an area of compliance for the tax office, and easy pickings or easy that say ping. Okay, I can see that it's been the same. You can pick it up on the label in the SMSF annual return. Just ask some extra questions and see what's happening there. No one wants to be in that position, so it's worthwhile making sure that you're not one of those people that's getting tapped on the shoulder.
Yeah, you're absolutely right. It's low-hanging fruit for the ATO. And it's pretty obvious too. So, it's sensible not to do that. Interesting. I think that you talked about relying on auditors to sort of pick this up. I actually think that they will be asking for a lot more information. I attended
Absolutely.
a seminar not so long ago where one auditor was suggesting that they get questioned about, well, how do we know what tenant's in there? From
Yep.
a real estate agent report, all they show is that the rent was paid, but how do we know who the tenant is in there? So that's from a related party perspective. So for them to be able to check that audit trail to say that that's not a related party that's in that property. But conventional practice has not seen that information asked for up until now.
Yep.
But they are suggesting that, well, if the agent's not giving you that, ask for it. It's just an added layer of protection that you might need.
Yep. Yeah.
For that.
And I think that with in recent cases, the auditors have been the ones on the hook for not asking further questions and things like that. And this is not supposed to be a topic about that. And, the auditors there a lot of extra requirements are being put on them that they sort of, it's not included in their scope, and it's a bit of a race to the bottom with some of their fees as well. So it's they can't possibly cover off on all of that with like some of the fees that they're charging if you think about what an auditor is required to do. But anyway, yeah. I heard a fantastic story of one of my staff said where they used to work, they were doing the fund, etc., and must have been chatting to someone and oh yeah, that street, oh do you know this person, oh yep, they knew the person that's owned by their fund. Oh, well, I know the kid is there. So it was actually being leased to a related party or a friend of the child, and the child was living there. So, that way of getting around it. And I was just like, oh God, you just don't want to be in that position where, if the whole neighborhood knows that your child's living there, it's a super fund asset. I mean, they're not necessarily going to make that connection, but you're just waiting for the time where someone's knocking on the door. Oh, who lives here? Da,
Yeah.
da, da. Which no one's got the resources to do. But I think to your point is, asking the question of, well, who is actually living there? What's the relationship of them? And is that more check-offs and sign-offs by the trustee saying, we acknowledge that no one residing in that property of the fund is a related party of the members or the trustees.
Yeah, I really do sympathise with the auditors being in the gun like that,
Mm,
because I think a lot of the onus that is put on them is maybe a little bit unfair in terms of what they're supposed to represent and what that sort of process is supposed to um, give assurance for. It
yeah,
can't cover
exactly.
everything, but it seems from certain legal case perspectives they want more and more. No, 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 no. You're just the complete safety net for everything, and I really do sympathise with them about that. But what can they do? They're in the gun, which means that obviously they're going to have to protect themselves, and they're going to ask for more information along those lines,
Yep.
which is understandable. But we'll move on.
Yes.
One of the other critical components to your year-end strategies has to do with pensions, doesn't it, Gemma? Because it's very
Yep.
important if you do want to continue to enjoy exempt current pension income, try and say that quickly, that you get your house in order as far as that goes too.
Yeah, and I think that we've had so many years where we've only had to take out half, or with some market linked pensions, 45%. So now we're back at the full whack. So it's really, really important that those pension payments are made in cash. So again, it's got to come out in cash, and you really want them paid again, not on the 30th of June on the Sunday, trying to get the money out of the super fund. That it happens well before then. It's sitting in the member's bank account. And then you've also had the opportunity to address any sort of issues that might have happened with the bank, like the money not being paid because the right authorization didn't happen and all that sort of thing. So a lot of members of SMSFs, they take those regular monthly payments and make sure that they've got that, that regular cash flow coming through. But others take it out at year end. They take it out once a year, and it's pretty close to the end of June from that perspective. That's certainly what my experience is. Or they take a top up towards the end. So it's important that we're aware of all of that and the timing, because there's only the concession for to still get ECPI if the shortfall pension is less than 1/12 of the total that's required for the year. And also it's a self-assessment sort of thing. If you've used that provision before and it's just a tax office guideline of the de minimis from that perspective, if you've used it before, then technically you're not eligible to self-assess again. So you want to make sure that those payments are made out of the fund in cash. And so that cash element can be a challenge for those with liquid investments. So do you need to be planning for the sell down of some assets? And again, depending on the sort of assets that are in the fund, are they international? So therefore, do you need the request to sell certain assets to go out a couple of weeks prior for those to be sold? All of those sorts of considerations as well. They're unlisted, so who's going to buy them off you? Do you need to transfer them from the fund? Do you need to buy them off the fund yourself to get cash in, and then that cash gets paid out? And then what's the market value of those? So back to that. So we only addressed property before. The other ones can be unlisted investments, and if they're unlisted property trusts, generally you can go to the fund manager and they'll tell you what that's worth. But if it's more closely held, or a private company that's more closely held or widely held, but a private company, then again, sometimes getting those valuations is a real challenge. So it's really managing that cash flow position. that might be in a fund and how that works. Helpfully, if you've got the ability to make contributions, then you could make a contribution in cash, and then he could use that to make a pension payment. So sometimes that can work from that perspective as well. But that in itself is certainly a challenge from a cash flow point of view.
Yeah, I'm amazed that anybody would actually again leave meeting their minimum pension requirement to the last minute. And I mean, this is probably, to me, this is probably more urgent than any sort of contribution strategy because you've already set that
Yeah,
arrangement up.
yeah.
But you don't want to jeopardize that. And there would have been a reason for setting it up. And of course, you want to enjoy as many benefits from that setup as you possibly can. Why would you possibly want to jeopardize that by not, you know, doing things before the very last minute? I don't get that. I know it happens, but I don't get that.
And I think you're right. There's some substantial adverse tax implications of not getting your exempt current pension income. So the biggest one is obviously not getting exempt from tax on income generated, but like substantial, like realized capital gains, like that can be massive. Yes, it's generally a 10% rate if on it if it comes through, but we're seeing a lot of people benefit from really substantial realized gains. And that's the last thing that you would want is for that to be hit with a 10% tax rate where it could be zero just by making sure that those payments are made. But yeah, one of the biggest issues is the cash flow position, but then that it has to be made in cash. And so that the timing and getting that all right. And really, we are short a few extra days of the year to make sure that happens, because you do hear of those situations of, oh, yep, I asked people go traveling. So it's prime school holiday time. And not to say that the people who are receiving pensions are going on school holidays, but, maybe it's a big family trip with mum and dad, the kids, and Nana and Papa, and off they go. And they forget they got in their emails, you need to authorize this payment coming out to do the final top up, and it doesn't happen. So, it's really important that people are on top of those sorts of things.
Yeah, absolutely, absolutely. Well, we'll move on. We've got a couple of topics still to discuss.
Yes.
And I suppose let's have a look at what you need to do with LRBA commitments.
Yeah, so with the LRBAs, if it's a related party one, that was really where I was going with that. So under the practical compliance guideline to fall within the safe harbour, the considerations there was it was regular monthly principal and interest repayments. So just to make sure that those are all up to date. Generally, the recommendation is always to make sure there's a direct debit coming through from that perspective, but just double checking that's the case. So that's the first one there. The other one is that, and again, at the time of recording of this, we didn't have the safe harbour LRBA rate for the 24-25 year. That hadn't come out. So to look at making sure that in the new financial year, setting up those regular direct debit payments from that perspective with that adjustment. So again, with those LRBAs, you don't want to, there's a safe harbour there. You keep knocking ahead, make sure it's set up to align with the safe harbour provisions, because the last thing that you want is if it doesn't align with that safe harbour, then you've got non-arm's length income and non-arm's length expense consideration. So it's really, really important that is nailed from that perspective. Yeah.
Yeah, you definitely don't want to go down the path of triggering the gnarly rules.
No, definitely not.
Because that will put you in a whole other world of hurt. Now, you did
Yes.
mention that's obviously we're talking about the related party sort of arrangements there, with loans and with gearing, but an associated, and we've touched on this a little bit already, an associated sort of concept with that is the in-house assets
Mm.
rules or
Yeah.
in-house asset rules. So of course, again, this is another area that people need to pay a little bit of attention to in the lead up to the end of the financial year, isn't it? So what are some of the things that they got to ensure that they get right? before we get to 30 June.
30 June. So there's a couple of things there. One that I do see is where people, it's not an in-house asset because it's an unrelated trust or an unrelated company. So that's great. So that means you're not subject to the 5% test. But the assessment of that or the testing of that is at the acquisition of the asset and then at 30 June for the year. So with that, again, the important factor there is making sure that it still is ticking the boxes of not being an in-house asset. And what can fall foul of that is, let's say someone becomes one of the directors. So you've got two. So Jemma and Darin are the directors of the corporate trustee of the unit trust, where each of our super funds has 50%. So everything's 50-50 down the line. So it's they're unrelated. So they're not in-house assets. But let's say I'm incapacitated. So automatically I'm removed as a director. So it's just you that's a director. All of a sudden, that asset at that time is an in-house asset of your super fund. Now, it might just require that replacement for me gets appointed from my family. So someone unrelated to you. So then it ticks the boxes. But if that doesn't happen, and at 30 June, you're the sole director of that company, then that's an in-house asset. That becomes an in-house asset of your super fund. And then when you're in excess of so it's not diabolical at 30 June for that particular year, but under the in-house asset provisions, if that ends up being more than 5% of the value of your fund, you've got to put in place a plan to dispose of the units in that unit trust, so to fall below the 5%. So that then can be a pretty ordinary outcome for your super fund. So that's one of the considerations. The other one is where clients do have in-house assets in their fund, but it's below 5%. So the consideration with that is whether they look at, okay, well, what might the value of the shares in that private company be? Am I going to go over the 5%? Do I need to make an extra contribution into the fund to make sure that we are under the 5%? Are there any other actions that can be taken from that perspective? So it's just being aware of how those in-house asset rules work, and the test time being at 30 June. Are you going to go over or under or trigger the in-house asset rules with a particular entity from that perspective?
Just with that sort of management of that 5% rule, Gemma, if you'd fallen foul of it, say in financial year, what are we talking about? 2022, 23?
Yep.
And you had to implement a plan to get it down. Like, how quickly do you have to do that? What sort of time frame do you have to implement that? Surely it can't span another financial year, because you would be looking at not being taking this seriously.
Well, and that's a really good point. So if you had you were over your in-house assets at 30 June 23, then you've got 12 months from 30 June 23 to implement that plan. And that plan is to dispose of an amount to fall under the 5%. So if you haven't done that by 30 June 24, then what happens then is that you're in breach of the in-house asset provisions at that point in time, and you haven't satisfied a time requirement. So then there would be an audit breach from that perspective. What invariably happens is that you identify at 30 June 23 in the process of doing the financial statements or annual return that there's a breach of the in-house assets test. Then generally you'd chat to the trustees and say, look, this has happened. Before we send it to audit, let's rectify it by dealing with it in the way that we need to. So then when it goes to audit can sign off and say, yep, no problem, it's been rectified, play on type thing. So that would be what that's the preference to sort of dealing with that. The other thing is that, and there's a bit of contentiousness there about the requirements in the legislation say dispose of. So you can't just put some more contributions in after that and say, oh, well, I'm under now. Now, I know of situations where that has been sufficient to sort of get it go through to the keeper, but technically the legislation says you've got to dispose of the interest to fall under the 5%. So again, it's important that people are aware of how all of that works and put in place the right mechanisms. And that is in itself a challenge. So who are you going to sell the unlisted shares to? If it's a related party, then it's yourself really. So can you pay it out as a lump sum payment? If you're not eligible to, you're going to have to buy the asset from the fund. It's got to be at market value. How do you get the funding for that? Do you have to sell the asset, like the underlying asset, from there? So it can have some substantial consequences that it's just not worthwhile trying to undertake if you can address it sooner rather than or before then. Preempt it all, just double check everything's all smooth. But back to that whole market valuation side of things, what is the market value of that? What's the market value of the fund? Are we going to stay within those realms, or are we going to push over? All of those sorts of things. Rather than it's definitely become, you can't just pick it up and do it with the SMSF annual return and financials. You almost need to be strategic and looking at things, preempting that those issues might arise.
In your experience, Gemma, have you seen any compliance action taken against people who haven't actually, by definition, disposed of the asset to get the asset values or the in-house asset values under 5%?
Most of the time we deal with it by a disposal, I have to say. Because there was a COVID concession. So if you were over and then within the next year, the value of, because it was when all those assets tanked, for want of a better phrase, although they bounced quite quickly.
Yeah,
But the
yeah.
consideration was, if because of your in-house assets, you end up being over the 5%, if it recovered within the following year, that you were okay. We've been able to sort of have a chat to the tax office on a couple of those and get those through. But most of the time it is requiring a disposal. And a lot of the issues that we're encountering in this space is it's a pre-99 unit trust that now has post 2009 reinvestments, or it's a original exempt unit trust or 13.22C unit trust that is no longer exempt from the in-house assets test that we're having to deal with. And a lot of them have got underlying property in them. So then we're looking at the consideration of, okay, how do we resolve this? Do we have to vest the property up to the unit holders to resolve it from that perspective, so that the in-house asset test gets dealt with?
Yeah, that's pretty tough, isn't it? Because I'm sure a lot of people would just think that, oh, well, if my assets are revalued and they're depreciated, then
Mm,
I'm fine. But it
that's
obviously
right.
doesn't quite work that way, which is a little bit inconvenient. And obviously it's to ram home the importance of sticking to the in-house asset rules, so you
That's
don't
right.
go to that
Yep.
5%. I can kind of understand that you need a disincentive, like an effective disincentive for people not to actually do that. Um,
And that also, to probably digress again, what we're also seeing with some of those related entities is, if it is an in-house asset, it's so overlaying the non-arm's length expense rules. So
yeah,
say, there's a related, or it was an unrelated entity. And so everyone's like, right, it's not an in-house asset. Sweet. Because you and I, we're 50-50 straight down the line.
yeah.
Okay, that sounds great. But how has that entity operated? So is it operating now within the realms of non-arm's length expense / non-arm's length income rules? Because if there's been a loan from other related on each side, everyone's thrown a loan into it. Has market interest been paid on that? Are there principal repayments from that perspective? It might be a property development. Well, who's actually the project manager? Is it a related party? Have they been paid properly for that? Like, all of those elements now require a lot more critique to make sure you're ticking the boxes from that perspective. And that's not just a 30 June, fix it and get it right. It really just needs to be that ongoing arrangement from there as well.
Now, SMSFs are obviously no different to any other sort of financial reporting vehicle that you have to service before the 30th of June. And I know when people are tidying up accounts, often they want to get all of their revenue and their expenses recognized in the correct year so
Mm.
that all the records are above board. And of course, that's another thing that we've got to have a look at, isn't it, Jemma, about the reimbursement potentially of any expenses that individuals should be reimbursed for that they may have incurred on behalf of the SMSF.
And that's right. So, what can often happen is you get the invoice for the fund, for the SMSF annual return or the audit or whatever that looks like. Someone pops on their phone, they see all their bank accounts and they're like, oh, yeah, I need to pay that. Oh, there's not enough money in the actual SMSF account. I'll just pay it out of Gemma's account. It's paid. So, I've done my bit. But then, of course, I've paid an expense on behalf of the fund, and that tax ruling 2010/1 says that if that is the case and it's not reimbursed, then that's a contribution by me to the fund. So is that going to fall foul of bring forward periods being triggered, all of those sorts of things? And so you want to make sure that if there are any reimbursements that they get addressed and repaid. So again, that's back to cash flow considerations and all those sorts of things. And I think it's easier to actually get it wrong because you just log in and you see all your accounts and they're under one page and you're like, oh, that one's got money in it, ping, and off you go. And it's the same with accidentally paying for personal expenses from the funds bank account because that obviously occurs as well. So if that has happened, again, you want to make sure that all gets addressed to mitigate any other audit issues.
Yeah, it's amazing how something which people would probably consider so innocuous
Mm.
about just the normal everyday management of their super fund could end up being such a massive compliance burden or compliance problem
Yeah.
if that little amount of money means that you've breached a cap or breached a threshold or something like that. And then again, like I said before, you're in another world of hurt
Yeah.
that number one, you didn't intend to do, and number two, you really don't want on your
Well,
plate.
especially with if you accidentally trigger a bring forward period. So it doesn't take much, then you're in a bring forward period. So it means you can't do your 360 next
Yeah.
year. And if you do your 360, then unlike before, it was like 2011 or 2013, where if you went over your non-concessional cap, you were like straight away 47%. I mean, that was diabolical. At least now we've got the excess, the refunding provisions, which say,
Yeah.
okay, Gemma, yep, you went over because you triggered your bring forward in 23, 24, but you've put in 470. So you're in excess by 140. Okay, so what does that look like? So that means that amount gets released. But again, people need to make sure that release happens correctly. So it's not like, oh, whoops, I'm over and I rip out 140. It's like, no, I've got to wait for the 25-year financials to be done, and then the tax office to tell me when I can take out my 140. Plus, I'm going to have an associated earnings amount taxed at my marginal rate with a 15% offset. Simples.
Yeah, that's not good. But the reverse situation where you think, oh, I'm a bit skinned. Oh, actually, there's some money in my fund.
Yeah.
Oh, no one will notice. I'll just pay it out of that. You could be going down illegal early access
Yep, that's right.
when you do that, and that really isn't something that you want.
And also, that's an area the tax office is very, they've indicated it's a high level of compliance activity for them, that illegal early access. So, again, it's almost anything that's got super on it. You've just got to, kit gloves a bit to make sure that you're not falling foul of some of those other bits and pieces that come through,
Well, I did
because
mean,
it's
yeah,
dealing with a compliance. So even if the tax office might not take any action because it's been identified, resolved, and then the auditor has said yes, it's a breach, but it's been rectified. So often where that's the case and it can be dealt with, the tax office might come back and say, we've noticed that you've breached this, but with no further action required. Just watch out. don't be so naughty next year. So great. But then the actual cost of that whole process can be substantial just in terms of someone having to knuckle down, roll their sleeves up and fix it.
Yeah, and I mentioned before that the ATO is red hot on valuations right now. Well, I think that you can up that. They are white hot on illegal early access. So if you
Yeah.
go down that path, you can definitely expect a knock on the door. Well,
Yeah,
I'm a little
that's
bit
right.
conscious of time, Gemma, so I think we'll probably wrap it up there, even though there's probably heaps of stuff that we can still talk about. It just occurred to me, I haven't been able to fit in a Simpsons or a Star Wars reference
Oh,
today, but I'm going to do that now.
oh,
But it's not quite as smooth
no,
as in the body of our conversation before. But I was thinking to myself that uh, we are recording this in May, and obviously it's going to, if you're viewing this or listening to this, we are already in June, but we missed an important date because we should
we
have done
did.
this on the 4th of May.
Yeah, we should have done
That's
it.
that's
Yeah,
Star
May the
Wars Day,
4th.
isn't it? Maybe
Yeah,
May the 4th be with you. So we've
yeah,
missed the trick there. Not
we
not
did
happy
miss the
about
trick,
that.
miss the
Should
trick.
should should have been more on the ball as far as that
Yeah,
goes. I
yeah.
mean, you're talking about year-end strategies. Maybe that's a year-end strategy a podcast year-end strategy that we should have been conscious of.
So it was the droids we were looking for.
Yes, yes, yes. So yeah, Jedi mind tricked.
Jedi mind tricks and all that sort of thing. Yeah,
That's
exactly.
right.
Now, just before we go, there was one more thing I just wanted to cover off on, and that
Yep.
was so we've been talking about make sure your minimum is paid. So if that's that's really really important for the exempt current pension income. The other consideration is if you've got clients paying out more than their minimum. So how do you deal with that? That might be the opportunity. Next year, it might be, right, we're going on a big nosh up holiday with the whole fam. It's going to cost XYZ hundreds of thousands. So next year, we're going to be pulling out X and it's going to be way a lot more than their usual. So is that when you put in place those preemptive documents for pension commutations, perhaps? Also, or they're treated as lump sums from accumulation rather than as pension payments. So
Yeah.
it's worthwhile if that's going to happen next year to put that in place. And then if you've got clients that have taken out those commutations in the current year, then just making sure that your T-bar is up to date for those partial commutations. And so far, I've definitely experienced those T-bars being lodged late, which isn't ideal. But unfortunately, life at the moment, trying to make sure that those get lodged on time. So if it was a payment in the current quarter that you want to partially commute, T-bars due by the 28th of July.
It's been all right so far because I don't think that the ATO has actually cracked down on anybody who has lodged their T-bar late, or certainly
Yeah,
I
that's
haven't
right.
heard of any situations of that being the case. But we can't rely on the grace of the ATO
No.
to
And it's
continue,
only a matter of time. These provisions have been in place for nearly 7 years. And so it's definitely only a matter of time.
especially when the regime is consistent now for everybody. It might have been a little
Correct.
bit
Yeah.
more difficult for them to keep track of who's yearly, who's quarterly. That's a little
Yeah.
bit hard. If everybody's on quarterly now, you've got no excuse, and it makes their data tracking a hell of a lot easier. So
Yeah.
don't expect that grace period to continue for very much longer. But as I say, don't leave these things to the last minute and don't risk these things. Why would you do it? I mean, you don't
Yeah.
want compliance issues with your funds.
That's exactly right,
That's
because it ends up
definitely,
costing you a lot more over, that
yeah.
probably short period of time to fix it and make sure that going forward you get a clean bill of health.
Yeah, this is definitely a case where prevention is
Is
far better
better.
than the cure.
Yeah,
Far better than the cure.
yeah, agree, 100%.
Anyway, Gemma, yeah, we'll probably wrap it up there. So I will thank you again for obviously being part of the Cross Country podcast. Thank you very much.
Thanks for having me and happy EFS or end of financial year, everyone. It's not that far away, and this year, like,
No.
where's the time gone? Goodness me. So
Well, I don't know. I can't believe that by the time people will be listening to this, we will be in June, which
yeah,
means that pretty much half the year is gone.
yeah,
And I honestly can't believe that that's gone so quickly. I say that every year. It is the
yeah, I
truth.
know.
It's
And it
just
gets worse and
flown.
worse as you get older,
It
Darin.
certainly
Worse and
does. It
worse.
certainly does. So there's no joy in the coming years for me to try and reverse that trend. But you know, it is what it is. But anyway,
Yeah.
thanks again, Gemma. It's great to see you on the Zoom and do another podcast with you. So thanks again. We thank everybody for joining us today. We hope you've enjoyed this discussion. As usual, we hope that it's been informative for you and it's raised some issues that might trigger some action to say you need to get some of the affairs in order before the 30th of June. Just a quick reminder that if you are accessing these podcasts on YouTube, please hit the like button and subscribe to our channel. Really important for us, all these social media and electronic matrix that we have to try and satisfy. So you can please give us a little bit of help as far as that goes. But other than that, thanks to Jemma again, but thank you more importantly for your company again. We're so pleased that you've tuned into this podcast and we look forward to having your company again the next time we do a super cross-country podcast.